A stock worth $500,000 lands in your hands, you sell it the next morning, and you owe the IRS exactly $0 in capital gains tax. But if your parent had sold those same shares the day before they died, the bill would have been $98,000. Same stock, same price, one day apart. Completely different tax outcomes. That gap isn't a loophole someone forgot to close. It's a deliberate feature of the tax code, and once you understand the mechanism, the whole thing clicks into place. To understand why, you need to know what the IRS actually taxes when you sell a stock. And it's not the full amount you receive, it's only the gain, the difference between what you sell it for and what you originally paid. That original purchase price is called your cost basis, and it's the number that controls everything. The formula is straightforward. Capital gain equals sale price minus cost basis, and your tax bill equals that gain multiplied by the applicable rate. The basis is the anchor. Change the basis and you change the entire tax outcome. Walk through the numbers. A stock bought for $10,000 decades ago is now worth $500,000. The owner sells. The IRS doesn't tax $500,000. It taxes the $490,000 gain. At the long-term capital gains rate of 20%, that's $98,000 owed, right off the top. The seller walks away with $402,000, not $500,000. Notice what's doing the damage here. It's not the sale price, it's the tiny original basis of $10,000. That one number, buried in the past, is what makes $98,000 disappear from the proceeds. Now ask yourself, what if that basis number could be reset? Before we get to that reset, there's a second variable that can make a large tax bill even larger. How long you've held the asset. Hold a stock for more than 12 months and the IRS taxes your gain at the preferential long-term rates, 0%, 15%, or 20% depending on your income. But sell even one day before that 12-month mark, and the gain is treated as ordinary income, taxed at the same rates as your salary, up to 37% at the federal level in 2024. That's nearly double the long-term rate. Same gain, same stock. The only difference is the calendar. Numbers on that 1 month difference are striking. An investor in the top tax bracket has a $490,000 gain and sells after 11 months. Short-term rate, 37%. Tax bill, $181,300. Now imagine they wait 30 more days, just one calendar month, and the gain flips to long-term. Rate drops to 20%. Tax bill, $98,000. That's $83,300 saved by doing absolutely nothing for 30 days. The holding period isn't a technicality. It's a $83,300 lever. So now we have two levers that control the tax, the basis and the holding period. And when someone dies, both get addressed at once. The mechanism at the center of everything works like this. When a person dies holding an appreciated asset, U.S. tax law does something remarkable. It resets the heir's cost basis to the asset's fair market value on the exact date of death. This is called the stepped-up basis. That original purchase price, the $10,000 paid decades ago, simply ceases to exist for tax purposes. The IRS replaces it with the current value. The sequence is precise. Death occurs. The IRS revalues the asset at that day's market price, and that new price becomes the heir's starting basis. All the appreciation that built up over years or decades is permanently erased from the tax ledger. Put real numbers on it. A parent buys Apple stock in 1990 for $10,000. Over the following decades, the stock climbs to $500,000. The parent dies. At that moment, the $490,000 in accumulated gains, 30-plus years of growth, simply vanishes for income tax purposes. The heir's new cost basis is $500,000, not $10,000. Not adjusted $10,000, not partially stepped up, exactly $500,000. The IRS treats the heir as if they had bought that stock on the day of death at that day's price. Every dollar of pre-death appreciation is gone from the gain calculation permanently with no mechanism to recapture it. Now the payoff of the opening question. The heir receives stock with a basis of $500,000. They sell it the next morning for $500,000. Capital gain, $500,000 minus $500,000 equals zero. Tax on zero, zero. Compare that to the alternative. The parent sells those same shares the day before dying. Basis is still $10,000. Gain is $490,000. Federal tax at 20%. $98,000 owed plus any state tax on top. Two scenarios, one day apart, same asset, same sale price. One generates a $98,000 tax bill, the other generates nothing. The stepped-up basis isn't just a tax reduction, it's a complete erasure. There's a bonus feature that most people don't consider. Not only does the basis reset, but the holding period resets too, in the heir's favor. Normally, if you buy a stock today and sell it tomorrow, your gain is short-term and taxed as ordinary income at up to 37%. But Congress carved out an explicit exception for inherited assets. Under IRC Section 12-23-11, inherited property is automatically classified as long-term, no matter how briefly the heir actually holds it. Sell it 2 days after inheriting, and any gain is taxed at the preferential 0%, 15%, or 20% rates, not 37%. The clock doesn't restart at 0 for the heir. A quick worked example to make that concrete. An heir inherits stock on January 1st and sells it on January 2nd. Literally 1 day of ownership. Under normal rules, that's as short-term as it gets, and the rate would be up to 37%. But Section 1223.11 overrides that entirely. The sale is treated as long-term. In this specific case, with the basis fully stepped up to $500,000 and the sale also at $500,000, the tax is still 0. The two benefits stack, but the long-term classification becomes critical if the stock moves at all after the date of death. Even a $10,000 post-death gain would be taxed at 20% instead of 37%, saving $1,100 on that increment alone. Now here's where people make an expensive mistake, and it's an intuitive one. A parent thinks, I'll just give the stock to my child now while I'm alive so they have it. Perfectly reasonable instinct, but gifting an appreciated asset doesn't get the stepped-up basis. It gets something called carryover basis. The recipient inherits the donor's original low basis from decades ago. The tax bill doesn't disappear when you gift the stock. It travels with it. The numbers make the mistake painfully clear. A parent gifts that $500,000 Apple stock, still carrying its original $10,000 basis, to a child while both are alive. The child sells immediately. Taxable gain, $490,000. Federal tax at 20%, $98,000. Now flip the scenario. The parent holds the stock, dies, and the child inherits it. Basis steps up to $500,000. Child sells, tax 0. Same stock, same family, same end result of the child holding $500,000 in cash, except in one version the family hands $98,000 to the IRS first. The gift cost $98,000 in avoidable taxes. Holding it until death would have cost nothing. So the stepped-up basis is extraordinarily powerful for capital gains, but it operates on a completely separate track from estate taxes, and that distinction matters enormously. Estate tax is a tax on the total value of everything someone leaves behind. Capital gains tax is a tax on the profit from selling appreciated assets. The step-up eliminates the capital gains exposure on pre-death appreciation, but it does absolutely nothing to reduce what the estate owes in estate tax. These are two different taxes with two different calculations governed by two different parts of the tax code. The federal estate tax exemption in 2024 is $13.61 million per individual. Below that threshold, there's no federal estate tax at all, and for most families, that's the end of the story. But estates above that exemption owe 40% on every dollar above it. Work through the numbers on a $15 million estate. The taxable excess is $15 million minus $13.61 million, which is $139 million. At 40%, that's roughly $556,000 in estate tax, completely separate from the capital gains savings the step-up provides. The step-up eliminated capital gains on all the appreciated assets, but the estate tax on the value above the exemption, that bill remains. Step back and look at the full picture. The stepped-up basis rule sits at the intersection of two things the tax code treats very differently. When you acquired something and how you acquired it. Buy it yourself and sell it. You owe tax on every dollar of gain, and the holding period determines the rate. Receive it as a gift. You inherit the donor's old basis and their full tax liability. Receive it as an inheritance at death. Your basis resets to today's value. All prior gains evaporate, and any immediate sale is automatically long-term. 3 paths, 3 completely different tax outcomes, same asset, same final sale price. There's a reason this rule has survived decades of tax reform debates. It's not an obscure technicality buried in a footnote. It's a fundamental policy choice about when to tax wealth, at the point of accumulation or the point of transfer. The stepped-up basis says, don't tax the growth that happened before death. Critics argue that creates an enormous incentive to hold appreciated assets forever and pass them on rather than selling. Proponents argue it prevents heirs from owing tax on gains they never personally received. Both sides are making the same observation about the same rule, they just weigh it differently. What's not debatable is the math. One day's timing difference, $98,000 in federal taxes, zero versus everything.